Tanger is an owner and operator of high-quality open-air outlet and lifestyle centers across the U.S. The company was actually founded 40 years ago, opening the first traditional outlet center, and today our portfolio comprises 38 outlet centers and 3 open-air lifestyle centers, aggregating over 16 million square feet. Now, our market-dominant shopping centers are located in dynamic and high-growth suburban markets and high-frequency U.S. tourist destinations. And our portfolio comprises over 3,000 stores across over 800 different brands and retail concepts, with our average store size of only 5,000 square feet. Now, Tanger is a REIT, and it trades on the NYSE under the ticker symbol SKT. The company's been public for over 30 years and has an equity market cap of about $4 billion and a total enterprise value of about $6 billion. Our strategy is to leverage our differentiated and best-in-class leasing, marketing, and operating platform to drive growth and value for shareholders. And really, this is achieved through 3 key pillars. It's our strong internal growth, it's intensifying the real estate that we already own, and it's expanding our portfolio through selective and disciplined external growth. And this is really supported by the strength of our investment grade balance sheet. We have low leverage, we have ample liquidity, and this really provides the company with the flexibility to continue to pursue selective external growth opportunities while also investing in our existing portfolio. And actually, over the last 2 years, we've added 6 new centers to the Tanger portfolio and deployed almost $800 million in accretive and strategic transactions. What's really unique about Tanger is our centers are led by local teams in each market, and that's backed by our regional and national platform and our corporate enterprise. And we're providing a well-rounded, high-quality shopping, dining, and entertainment experience that's really attracting new retailers and new shoppers to Tanger centers. And we're also bringing newness into our centers because it's our job as the landlord and the operator. How can we get someone off their couch and into the center? And we want to attract younger consumers, younger shoppers, drive traffic, drive sales, and drive longer dwell times. And we're driving a lot of this growth through our retailer, shopper, and asset focus, leveraging technology, bringing a data-driven approach to everything that we do. We've modernized our loyalty program, which is now app-based. We've been activating our peripheral land. We're hosting events at our centers because they're the local focal point of their communities that we serve. We're growing our ancillary revenue base, not only marketing our assets to drive traffic, but selling our assets as marketing mediums. And coming out of the third quarter, our portfolio reached all-time sales productivity of $475 per square foot. And we also achieved our 15th consecutive quarter of positive leasing spreads. So Tanger was founded by Stanley Tanger and his son, Steve Tanger, in 1981, and the company went public in 1993, really at the dawn of the modern REIT era. But what's really interesting is the origins of the business go back to 1919. So over 100 years ago, Stanley's father and Steve's grandfather, Mo, the family was in the manufacturing business in North Carolina. They were making police and fire uniforms, shirts and trousers. And within any manufacturing business, there was excess product. And the Tangers wanted to turn that excess inventory into cash. And so Mo decided on Saturday he was going to open a store for his employees and their friends. And so really created the first outlet store back in the 1920 era. And over time, they ended up selling the business in the late 70s. In 1979, they had 5 of these outlet stores at the time, and they convinced some other manufacturers to join them in what became really the first outlet center with multiple brands and retailers in one spot. And that history and that knowledge, and over the last 40 years, the company has actually touched over 75 different outlets. Today we have 38 outlets and 3 lifestyle centers, which really was the expansion of the business post-COVID. And so if we fast forward over that public history, which was very successful, our company went through a management succession plan with the hiring of Stephen Yalof, who became our CEO effective at the beginning of 21, but was hired in April of 2020 to become the CEO. And Steve's background, having run our competitor's largest portfolio for 6 years prior to joining Tanger. But what really makes Steve unique has been he spent 25 years in the retailer business. So he sat at Polo and at the Gap running real estate on the tenant side, and actually started leasing outlets in the mid-90s for another REIT that had them. And so couldn't have found a better operator, leader to take this business, which has been very successful, and continue our growth outlook. With Steve coming on board, we've had a refreshed management team and have invested a lot in our company. And one of our big moves in late 23 was taking the company and broadening the scope of what we do to go into open air lifestyle centers, which share the same tenants, same specialty retailers. They operate the same way. And from a marketing standpoint, in the outlet business, it's our job as the owner and operator to drive traffic to the outlets. And so we really feel that that's a competitive advantage at Tanger that has benefited as we've moved into the lifestyle center space overall. Now, as a REIT, which has been around since the 1960s, but really got growth coming out of the 90s, there's tremendous benefits of being a real estate investment trust. Having the access, the cost, and the permanence of capital to be able to match that with long-lived assets is tremendous. In REITs, just by the very nature, there's over 150 different public REITs. They really offer an investor, whether they're an institutional owner or a retail owner, the ability to invest in commercial real estate that they really can't get on their own. You look at the size of our company or all the different sectors in REITs, professionally managed, reporting that keeps everyone informed on what's going on, and being very disciplined around that growth. And one of the key things of being a REIT is our requirement to pay a dividend. And that dividend not only is a strong yield for an investor, but it also is a governor on capital allocation. Because there's less free cash flow available to a REIT, because they are paying a dividend, it means you got to be really smart about how you invest and retain that free cash flow after you pay your dividend. And for Tanger, we're currently operating at a 60% payout ratio. And what that means is our dividend over our free cash flow, it's set at 60% currently. The REIT industry is 75 to 80. That means we're retaining a greater share of our cash flow to invest in our business or support our external growth. And that gives us a little bit of a competitive advantage, and also allows us to increase our dividend alongside cash flow. It's also, real estate being the largest asset class everywhere when you look outside. And so that REIT industry and being able to turn real estate into liquid form, we think is very attractive. Our business has been around for over 40 years. It's an extraordinarily resilient sector that has offered a lot of growth opportunities. And importantly, the bricks and mortar channel for our retail partners and the brands is really important to both the shoppers as well as to retailers. And you think about being a shopper, coming to an outlet center or one of our open air lifestyle centers, the customer and the shopper gets to visit the most in-demand, the most iconic, and as well as new brands and product lines within that retailer and brand's store environment, right? They're not going to a multi-brander and shopping on a rack. They're getting to shop that retailer's full line environment. And when you come, shopping, our centers offer a full roster of categories from apparel, athletic, footwear, accessories, beauty, home, books, toys, games, and an increasing amount of food, beverage, and entertainment, which really provides this full social experience to shoppers. I mentioned early on, we have to compete with someone to get off the couch. And so how do you get them into your center and be able to provide that experience? And I think importantly at our outlet centers, there's always value. And so a customer who shows up and they know it's a purposeful shopping experience, but one that they're going to get value. And value, whether it's good times or bad times, never goes out of fashion. And you think about the other side of the equation to the retailer and why bricks and mortar is so important to them. They get that direct consumer touch point, right? When you show up at the cash register at one of the athletic retailers and they'll ask you want to join our loyalty program, they'll be able to follow up with them. So that customer acquisition cost and that store being part of their overall omni-channel strategy is really important. And being able to be in high traffic locations. And a lot of our portfolio, when you look across the US, right, we're in these high density US drive-through tourist destinations that have an increasing amount of permanent population. So our portfolio has significantly benefited from that growth. And then from the retailer's perspective, they also want to grow beyond their direct-to-consumer channel. And so being able in that store environment to have that. I think the other backdrop that's happening within the retail real estate sector that really is a benefit today is the fact that there's no new supply. There's no real new retail development. And when there's not a lot of new development, what that means is the existing stock just becomes that much more valuable. It also means that acquiring assets at a discount to replacement cost is even more valuable. And so when we think about this lack of supply combined now with this robust leasing environment as tenants are searching for space, it helps us improve our tenancy, it improves our NOI, we can replace some underperforming tenants, we can right-size some larger stores, we can diversify our merchandise assortments, and we can really encourage reinvestment from our tenants. And so, there's a number of positives that exist for our retail real estate sector. I think about the business and, we talked about how long the business has been around. Remarkably, there's still some misperception that our centers are located in very remote or tertiary locations. And we have some great overheads, and Google's a wonderful thing because it keeps a lot of the historical aerial footage. What's happened, when our centers were first developed, they were a little bit more greenfield. But given the significant population growth and further development, our centers today are the center of their communities. And the amount of things that have been built up in and around is what's driving so much of our leasing success. In addition, it has allowed us to expand the scope of the type of uses that are in our centers, because you're having larger daytime populations in and around our markets, you're having growing populations. And so just overall, I think that part is still some of the biggest misperceptions. And what we encourage all of our financial stakeholders to do, and we've been doing a lot of it, is come visit with us, come shop, come see what it's like. And we're a big believer in seeing is believing. And we welcome all of you to come out and shop one of our centers across the US, sign up for text messaging, sign up for our loyalty program, and be part of the ecosystem. You know, when we think about Tanger, and no two companies are the same, I think for us, it starts with our people and our culture. You know, we have local teams on the ground at every asset that we own and operate. We have this tremendous field-led organization and a corporate enterprise that is supporting ultimately our product, which is our centers, our people, our communities, our retail brand partners, and all of our financial stakeholders. It gets supplemented by what we believe is our differentiated and best-in-class leasing, operating, and marketing platforms. We have very long and trusted relationships with our retail partners. And that is a really critical ingredient, because in any landlord-tenant relationship, there's always a little bit fraught with tension. But in the retail business, a retailer's success is our success, and our success should be their success. And so having that long and trusted relationship and helping them achieve their business outcomes, and both of us standing up to deliver for our respective shareholders. The other thing I think that what sets us apart is, our portfolio really is evolving into 7-day-a-week destinations. Due to this substantial change in demographics and that outward population migration from urban to suburban markets that we sort of touched on. And what this has done is contributed to that strong traffic generation in our markets, where the residential growth really continues at unprecedented levels. And for retail, you follow the rooftops, and that's what's happening. So we're benefiting from what's going on in our local geographies, and we're being able to capitalize on it because of our platform. And all of that has fueled the differences relative to the uses that are in our centers. I touched on marketing a little bit earlier in our conversation. Marketing is in our DNA. It's our job to drive the traffic to our centers. We think we do that really well. We think being in the outlet business, because it is a core competency, allows us that's a competitive advantage as we purchase and grow our lifestyle centers. I think we're ahead of the game on our digital engagement. I don't know many REITs that actually have an app that we don't sell a product, right? We sell our retailers sell products, but we've created a loyalty program. And then that just means millions of impressions in the digital world, whether that's through TikTok or Instagram or Facebook, as a real way to inform the marketplace. And last, I'd say, we have an experienced leadership team. We have a proven track record at operating, developing, and acquiring centers. We have a lot of embedded growth potential. And the biggest part is, from a financial perspective, we have a dividend that's well supported by free cash flow, which not only provides security, but the opportunity for continued dividend growth. It allows us to retain free cash flow to reinvest in our assets and add liquidity for external growth. And then our balance sheet that has the lowest leverage in the space, that is really positioned with low leverage and a lot of liquidity. And so from just a financial standpoint, we feel that we're really well positioned within the industry.